Every major California homeowner financial crisis has followed the same sequence. A risk builds slowly. It is visible in public data to anyone who looks carefully. The industry minimizes it because acknowledging it would slow transactions. Buyers proceed based on historical precedent and the assumption that the professionals they are paying to protect them would flag anything serious. Then a threshold is crossed, and the consequences arrive faster and hit harder than anyone standing inside the market projected. It happened with seismic risk in communities built on liquefaction zones before the Northridge earthquake exposed what the soil surveys had been quietly indicating for decades. It happened with adjustable rate mortgage exposure before the previous crash, when the payment reset schedules that were printed in every loan document were systematically understated as a risk factor by every party in the transaction who profited from closing the deal. It is happening right now with wildfire risk. And the current system is failing buyers in 3 specific ways that this breakdown is going to make impossible to ignore. The buyers who understand where this risk currently sits on the historical sequence are making fundamentally different decisions than everyone else in the California market right now. Some of them are walking away from properties that would have been considered premium purchases 12 months ago. Some of them are negotiating price concessions that the sellers have not yet accepted because they do not yet understand what the insurance market has already priced in about their asset. And some of them are identifying the specific properties and micro-locations within California's wildfire-exposed regions where the risk is manageable, the disclosure is genuine, and the pricing correctly reflects the true carrying cost structure. There is a specific mechanism in California's current insurance regulatory environment that most buyers, and frankly most agents, do not understand. It determines whether a property you are considering will be insurable in 3 years. Not whether it is insurable today. Whether it will still be insurable after the next major fire season reprices the surrounding risk pool. I will show you exactly how that mechanism works and how to identify whether it applies to a property you are evaluating. But first you need to understand how California arrived at a place where the standard disclosure and transaction process systematically underrepresents this risk. The 3 failures. I referenced 3 specific ways the current system is failing buyers. I am going to name 2 of them now and hold the third because it is the one that will genuinely surprise even buyers who consider themselves well-informed about California wildfire risk. The first failure is in the disclosure framework. The second is in the valuation methodology. The third, which I will return to, is the one that is actively accelerating the problem rather than containing it. How the disclosure system is failing. California has some of the most comprehensive real estate disclosure requirements in the United States. Sellers are legally required to disclose known material defects. Agents are required to conduct visual inspections. And transactions in high fire hazard severity zones require specific natural hazard disclosures that inform buyers of their property's official fire risk classification. That system sounds protective. In practice, it has 3 structural gaps that combine to leave buyers materially underinformed about their actual risk exposure. The first gap is the classification lag. California's high fire hazard severity zone maps are updated periodically, but the actual fire risk in many areas is being repriced by the insurance industry on an annual basis using satellite imagery, fuel load data, and historical fire behavior modeling that is considerably more sophisticated than the state's zoning classifications. A property can sit in a zone officially classified as moderate risk while the insurance industry's internal models have already reclassified the surrounding area as high risk. The disclosure tells the buyer the official classification. It does not tell them what the insurance market has already concluded about the property's actual risk profile. Here is something most people completely overlook. The insurance non-renewal notices that have been landing in California homeowners' mailboxes are not random. They follow a geographic logic that reflects internal risk modeling that is more current and more granular than any publicly available fire hazard map. When major insurers begin withdrawing from a specific zip code, they are telling you something about that area's risk trajectory that the official disclosure documents are not required to convey. The second gap is the perspective versus historical framing of risk. California's disclosure system is built around historical data. Has this property experienced a wildfire? Is it in a zone that has been designated based on past fire behavior? These are backward-looking questions. The risk that is most financially consequential for a buyer making a 20 or 30-year ownership commitment is forward-looking. Climate-driven changes in fire season length, fuel moisture conditions, and wind pattern behavior are shifting the risk profile of California communities in ways that historical fire maps do not capture. A neighborhood that has never burned and sits outside traditional high-hazard zones can face materially elevated forward risk based on current vegetation conditions and infrastructure density that no current disclosure document addresses. Pause. The disclosure you receive at closing tells you where fire has been. It does not tell you where fire is going. The third gap is the most consequential, and it connects to the third failure I referenced at the start of this breakdown, the one I have not yet fully named. It is the insurance availability gap at the point of resale rather than at the point of purchase. A buyer can close on a California property today with standard homeowners insurance in place and technically satisfy every disclosure and lender requirement. What the disclosure does not reveal is the probability that this insurance will be non-renewed within the next 1 to 3 years as the insurer's portfolio-level exposure in the surrounding area forces a retreat. And without that insurance, the next buyer of the property may be unable to obtain conventional mortgage financing, which structurally constrains the resale buyer pool and directly impairs the equity value of the asset. The disclosure failure is the entry point of this problem. But it is not the most financially dangerous part. The valuation methodology failure is where the actual equity destruction is being engineered. And that is exactly where this gets serious. The valuation trap. How prices are hiding the real risk. California home valuations in wildfire-exposed areas are currently being supported by a set of market dynamics that are concealing a structural repricing that is already underway in the insurance market. Standard residential appraisal methodology in the United States is a comparative sales approach. An appraiser identifies recent transactions in comparable properties and establishes value based on what the market has paid. The problem in California's current environment is that the comparable sales data being used to support current valuations reflects transactions that closed before the most recent wave of insurance market withdrawals reached their full effect in those specific zip codes. In other words, the appraisal for the property you are buying today may be based on sales that occurred when the seller, the prior buyer, and the lender were all operating under insurance availability assumptions that no longer apply to that market. The price looks supported by comparables. The comparables were generated in a different insurance environment. The current insurance environment has already repriced the risk in ways that will eventually force a valuation correction that the comparable sales data has not yet absorbed. This is what I was referring to earlier when I said the valuation methodology is the second failure. It is not that appraisers are doing anything wrong within the framework they are required to use. It is that the framework is structurally backward-looking in an environment where the risk is changing faster than historical transaction data can capture. The result is that buyers are paying prices supported by appraisals that are, through no procedural fault, based on data from a risk environment that no longer exists. The insurance market does not wait for comparable sales data to catch up. It prices current and forward risk in real time. When Farmers, State Farm, Allstate, and multiple other major carriers announced they were pausing or stopping new homeowners policies in California, they were making a statement about their assessment of current forward risk that the transaction market had not yet fully absorbed. The historical parallel that most accurately captures this dynamic is not another wildfire event. It is the coastal flood insurance repricing that preceded major valuation corrections in certain Gulf Coast and Southeast Atlantic markets. In those markets, the insurance market's forward risk assessment was visible years before it forced the valuation correction. The buyers who recognized the sequence bought the insurance market's behavior as a leading indicator of the valuation correction to come. The buyers who dismissed it as a temporary market disruption experienced the equity impairment when the correction arrived. The insurance withdrawal is not the problem. It is the signal. The problem it is signaling is a structural repricing of California real estate risk that has not yet completed. There is a specific category of California property where this valuation gap is most acute, and it is not the category most buyers assume. It is not the rural mountain cabin or the isolated hillside estate. It is the suburban interface community, the master plan development built at the edge of open space. The newer construction subdivision in a foothill location that was developed during a period when both fire risk modeling and insurance pricing were more favorable than they are today. These properties look like standard suburban real estate. They are priced like standard suburban real estate. And they carry fire interface risk that the insurance market is actively repricing in real time while the transaction market catches up on a multi-year lag. The specific mechanism. I referenced earlier a specific mechanism in California's insurance regulatory environment that determines whether a property will be insurable in 3 years, not today. I'm going to name it now because it is the piece that connects the disclosure failure and the valuation trap into a single coherent risk picture. It is the Fair Plan Exposure Threshold, and its implications for California homeowners are considerably more serious than most current owners understand. Now that you understand how both the disclosure system and the valuation methodology are failing buyers in tandem, the critical question is what the Fair Plan mechanism means for existing owners and prospective buyers right now. And this is where most investors get caught. The Fair Plan Trap. The third failure revealed. California's Fair Plan, the Fair Access to Insurance Requirements Plan, is the state's insurer of last resort. It was designed as a temporary safety net for property owners who genuinely cannot obtain coverage in the private market due to elevated risk. It was not designed to function as the primary insurance mechanism for hundreds of thousands of California homeowners in suburban and semi-rural communities. That is now what it is becoming. As major private insurers have withdrawn from or significantly reduced their California exposure, the Fair Plan's policy count has grown dramatically. The plan's total insured exposure has expanded to levels that have prompted serious actuarial concern about whether the plan could meet its claim obligations following a major catastrophic fire season without requiring an emergency assessment against all California property insurers, which would ultimately be passed through to policyholders statewide. Here is the mechanism I was referring to earlier. When a property's only available insurance option is the Fair Plan, the property's insurability for conventional mortgage financing becomes contingent on the Fair Plan's continued availability and financial stability. A property that can only be Fair Plan insured today is a property whose resale buyer pool is constrained to buyers who either do not require mortgage financing or who can obtain a lender that will accept Fair Plan coverage. As Fair Plan coverage becomes more expensive, more limited in scope, and more uncertain in long-term availability, the effective buyer pool for these properties narrows. And a narrowing buyer pool is a structural driver of valuation pressure that does not require an actual fire to materialize. This is the third failure in California's current system. The Fair Plan was intended as a temporary bridge between private market withdrawal and eventual return. In practice, in the current cycle, it is functioning as a permanent replacement for private coverage in an expanding geographic footprint of California communities. And because the Fair Plan's long-term financial stability depends on its ability to manage catastrophic loss exposure that is growing as climate conditions change and development patterns push more structures into fire-adjacent locations, its role as a reliable foundation for property insurability over a 20 or 30-year ownership horizon is genuinely uncertain. The buyers who understand this dynamic are asking a different question than the standard insurance inquiry at closing. They are not asking whether the property is currently insurable. They are asking whether it will remain insurable on terms that support conventional financing and normal resale activity over the full holding period they are planning for. And for a significant and growing share of California properties in fire-exposed markets, the honest answer to that question is unknown in a way that the current transaction process does not require anyone to acknowledge. Here is what nobody tells you. The question is not whether you can get insurance today. The question is whether your next buyer can. The equity destruction sequence. Historical parallels. The financial consequences of this three-part system failure are not hypothetical. They are already visible in the transaction data of communities that have been at the leading edge of the insurance market withdrawal. In the aftermath of the Camp Fire in Butte County, property values in Paradise and surrounding communities did not simply decline proportionally to the physical damage. They experienced a more complex and in some ways more instructive pattern. The physically undamaged properties adjacent to the burn zone, properties that suffered no direct fire damage but now existed in a market where insurance availability was severely constrained and buyer confidence was fundamentally altered, saw transaction volumes collapse and days on market extend dramatically. The equity destruction in those properties was not caused by fire. It was caused by the repricing of insurability that fire exposure triggered in the surrounding market. This is what I was pointing toward at the start of this breakdown when I said this has already happened to thousands of California homeowners. The equity loss does not require your specific property to burn. It requires the surrounding market's insurance and financing environment to deteriorate to the point where the buyer pool that can transact in your neighborhood at your expected price contracts below the level needed to support current valuations. That sequence is not a theoretical future risk in several California markets. It is an observable present condition. The historical parallel that most precisely captures the current moment is the S&L crisis period's effect on Texas real estate in the mid to late 1980s. In that case, a structural financial mechanism, the collapse of savings and loan institutions that had been the primary financing source for Texas real estate, removed the financing infrastructure that supported existing valuations. Properties did not lose value because the underlying assets changed. They lost value because the mechanism that connected willing buyers to available capital broke down. The current California situation is analogous. Properties are not losing value because they are structurally different from what they were. They are losing value, or accumulating latent value risk, because the insurance mechanism that connects willing buyers to available financing is breaking down in specific markets. The Texas real estate market took most of a decade to fully work through the consequences of that structural mechanism failure. The recovery required not just a stabilization of the underlying financial system but a wholesale repricing of assets to levels that reflected the new financing reality. California's wildfire insurance crisis is a different mechanism producing a similar structural dynamic. And the timeline for resolution, in the absence of fundamental changes to either the regulatory framework or the underlying fire risk trajectory, is measured in years rather than months. Understanding the historical parallel tells you what the sequence looks like. The more urgent question is what the smart money is doing right now in response to this sequence, and what that behavior tells you about where the opportunity exists within California's wildfire-exposed markets, because it does exist, just not where most buyers are currently looking. Smart investor behavior. How informed capital is repositioning. The informed capital response to California's wildfire insurance crisis is not a wholesale exit from the state's real estate market. That is the unsophisticated response, and it is not what the transaction data shows sophisticated buyers doing. What the data shows is a systematic repricing of location-specific risk within fire-exposed markets, combined with a reallocation of capital toward the specific property categories and micro-locations where the insurance and financing infrastructure remains stable. The risk is genuinely disclosed and priced in, and the entry point reflects the true carrying cost structure rather than a pre-crisis comparable sales basis. The first category of repositioning is the exit from suburban interface communities with limited egress infrastructure. The properties that carry the most concentrated wildfire financial risk are not the rural retreats. They are the master-planned suburban developments built at the urban wildland interface with road network designs that were optimized for commute convenience, rather than emergency evacuation capacity. Single road access, cul-de-sac-dominated street patterns, and proximity to continuous fuel loads combine to create the conditions that fire behavior models identify as highest risk for both structural damage and civilian casualty. Informed buyers are specifically screening for egress capacity as a primary evaluation criterion, not as a standard due diligence item but as a dispositive factor that can exclude an otherwise attractive property from consideration. That assumption that newer construction is safer? It is costing people who have not read the egress data real money. The second category of repositioning is the preference for properties with documented ember-resistant construction and defensible space compliance. California's state fire code and local ordinances increasingly require defensible space clearing, and in some jurisdictions specific construction standards for new development in high fire hazard zones. Properties that have documented compliance with these requirements, and that have the physical site characteristics to maintain compliance sustainably, are carrying a meaningfully different risk profile than superficially similar properties that lack either the documentation or the site conditions to support ongoing defensible space management. Informed buyers are requesting this documentation explicitly rather than accepting the standard disclosure process as sufficient. The third category is the geographic reallocation toward communities with private fire protection infrastructure. A small but growing number of California communities, particularly higher-end residential enclaves, have invested in private fire protection services that supplement public fire department response with dedicated equipment and personnel staged within the community. These arrangements, while expensive and available only at specific price points, fundamentally alter the risk calculus for covered properties by improving both. The second step is the egress analysis. Obtain the parcel map for the property and identify every legal vehicle route from the property to a major arterial road. Count the number of independent egress routes that do not share a single point of failure. A property served by a single road that can be blocked by a single downed tree or single structure fire has a materially different evacuation risk profile than a property with two or more independent egress routes. local fire department planning documents, and community evacuation plans, which are public records in most California jurisdictions, often contain explicit assessments of evacuation capacity by neighborhood that provide a level of specificity that no standard real estate disclosure approaches. The third step is the defensible space and ember resistance audit. California's Board of Forestry and Fire Protection publishes specific standards for defensible space zones around structures, and local fire agencies conduct periodic inspections in some jurisdictions. Requesting the most recent inspection record, if one exists, provides documentation of the property's current compliance status. For properties without recent inspection records, a qualified fire safety consultant, distinct from a standard home inspector, can assess both current compliance and the site's physical capacity to maintain compliance sustainably given its topography, vegetation type, and proximity to fuel loads. Most buyers skip steps 2 and 3 entirely. This is where the expensive surprises live. The fourth step is the Fair Plan Exposure Assessment. If the insurance market test in Step 1 reveals that standard market coverage is unavailable and fair plan coverage would be required, the financial analysis of the purchase must incorporate the full fair plan cost structure, including the companion policy required to fill coverage gaps the fair plan does not address, and must explicitly model the carrying cost impact of fair plan premium trajectory rather than assuming stability. Fair plan premiums have been rising, and the plan's coverage scope has been contracting. Underwriting based on current fair plan costs without accounting for trajectory risk is underwriting based on an assumption of stability that the plan's own financial situation does not support. The fifth step is the resale market liquidity stress test. For the specific property you are evaluating, in the specific zip code, identify what share of comparable property transactions over the past 12 months have closed with conventional mortgage financing versus cash or non-conventional financing. A market where cash transaction share is rising sharply is a market where the conventional financing infrastructure is already deteriorating. That deterioration directly constrains your future resale buyer pool and should be reflected in either your offer price or your decision to proceed. Where the genuine opportunity exists. California's wildfire insurance crisis is creating genuine financial danger in specific market segments. It is also creating genuine opportunity in others. The two are not separated by a simple geographic line between fire-exposed and non-exposed areas. They are separated by the quality of disclosure, the accuracy of pricing, and the presence or absence of the risk mitigation infrastructure that determines whether a specific property in a fire-exposed area is a trap or a legitimate risk-adjusted opportunity. The genuine opportunity exists in 3 specific categories. Properties in fire-adjacent communities where the risk has been fully and accurately priced into the purchase price, where insurance availability has been confirmed through the 5-step framework, and where the defensible space and construction standards genuinely support the risk profile. These assets are trading at discounts to comparable properties in non-exposed areas that in some cases exceed the actuarial value of the incremental risk. For buyers with the operational knowledge to evaluate them correctly and the holding capacity to sustain them through the insurance market normalization cycle, the risk-adjusted return profile is more favorable than the headline risk narrative suggests. This is exactly why it matters to understand the full picture rather than accepting the simplified narrative in either direction. The bears who say all California fire-adjacent real estate is uninvestable are as wrong as the bulls who say the insurance withdrawal is a temporary disruption that will self-correct. The reality is a market in transition where accurate information creates genuine asymmetric opportunity for buyers who have it and genuine financial danger for buyers who do not. The second opportunity category is the market segment immediately below the fire interface. Communities that sit in lower-risk topographic positions within fire-exposed regions and that carry residual discount from the regional risk narrative, even though their specific site characteristics place them in a materially different risk profile than the interface communities generating the headlines. These micro-location distinctions are invisible in zip code level data. They require site-specific analysis that most buyers and most agents are not currently conducting. That information gap is where the opportunity lives. The third category is the proactive risk mitigation premium. Properties in fire-exposed regions where owners have invested in documented ember-resistant retrofits, maintained certified defensible space, and secured private fire protection access are increasingly maintaining standard market insurance access at premium levels that represent a manageable carrying cost. The resale premium for these properties relative to comparable unmitigated assets in the same market is growing as the buyer pool becomes more sophisticated about the insurance implications of fire risk. The spread between mitigated and unmitigated properties in the same fire-exposed micromarket is widening in ways that reward investment in mitigation infrastructure. The closing. What the sequence is telling you. California's wildfire risk is not a new story. What is new in the current cycle is the convergence of three failures that are turning a manageable risk into a systemic financial threat for buyers who are not asking the right questions before they close. The disclosure system is failing because it looks backward at classified risk rather than forward at repriced risk. The valuation methodology is failing because it is based on comparable sales from an insurance environment that no longer exists. And the FAIR plan is failing in its intended role because it has become the primary insurance mechanism for a market it was designed to serve as a last resort, not a foundation. Here is the final convergence of everything this breakdown has established. The sequence California is following right now has been followed before. Seismic risk. Adjustable rate exposure. Each time, the warning was visible in the structural data before it was visible in the transaction data. Each time, the buyers who read the structural data rather than the transaction data made fundamentally different decisions. The insurance market's behavior in California right now is structural data. It is not noise. It is signal. And the buyers who understand what it is signaling, and what that signal means for the specific properties they are evaluating, are the ones who will look back on the current cycle as the moment their financial judgment either protected their equity or cost them it. The three questions every California buyer in fire-exposed territory should be able to answer before they close are now in your possession. Can you confirm standard market insurance coverage through an independent broker before you submit your offer? Can you identify at least 2 independent egress routes from the property to a major arterial? And do you know what share of comparable transactions in that specific zip code have been closing with conventional financing in the past 12 months? If you cannot answer all 3 with specificity, you are not yet informed enough about the property to make a sound capital commitment. That is not a criticism. It is a statement about what the current California market requires of buyers in fire-exposed territories that the standard transaction process does not provide. What California will not tell you before you buy is not a secret. It is a gap in a disclosure system that was built for a different risk environment than the one that now exists. The buyers who fill that gap with their own due diligence will make informed decisions. The buyers who rely on the system to fill it for them will find out after closing what the insurance market already knew before.